Now, everybody, welcome to another edition of Your Money Radio. Danny Stewart, Dividend board here with you live. Whenever you're listening to this, watching this, we are with you live. Trust me on this. But I've got a lot I want to cover. I want to talk about Don got into a back alley fight this week that I think I want to cover. That's a tease, Don. What's that? That's known as the tease. Danny doesn't know what I'm going to talk about, so you'll probably see Danny's breath get cut off from the neck up. His face will turn red. He has no idea what back alley fight I'm talking about. Maybe he does, and he's really scared about how I'm going to approach it. But we're absolutely positively going to talk about Don's back alley fight this week. But before I do this, and I'm dramatizing that, it was more like a kerfuffle. Kerfuffle. I don't know how to spell it, but I'm pretty sure it's a word. So here we go. I
can be an a-hole. I was called an a-hole while I was polite. So this guy must be really sensitive to what's going on.
We'll get there. But what I think you're seeing happening here in the NASDAQ, I'm looking at a daily chart of the NASDAQ futures now. We are clearly off the highs, right? Doesn't take a rocket scientist to tell you that. But what it does take a little bit of rocket science tree is to point out this that's taking shape right here, which on a daily chart is an inverse head and shoulders. Now, it doesn't have to play out this way, but inverse head and shoulders are really powerful rebound patterns. It's the type of rebound pattern that, do you see how on my charts here, like we get a ton of new viewers every week. So let me just outline these really quick. That's a 5, an 8, and a 21. Those are all exponential. 34 exponential, and the 50-day I keep simple. I got a 50-day simple on this chart here, and I'll haul the way down here somewhere.
Moving averages.
Yeah, moving averages. Thank you. And so, and these three here are based on Fibonacci sequence. And so this is, if we didn't have this inverse head and shoulders pattern developing, I would say that you're probably going to climb above the 8 next week, go up to the 50 and the 21, and there's going to be a battle to take place. And I still think that's going to happen, but I think this is the kind of pattern that gets you back up to the 50% retracement of the move high, and it should be going lower. This actually, I should redraw that line. This line is inaccurate. So as a matter of fact, let's do that right now. Since I failed to do that, Daniel, I'll do it right now for you. And so when I'm looking at this, the high to the low, 11,560. Here, let me just tap that out there. See if I can get it to freeze. So I'm looking for a move between 11.5, like 11.4 to 11.4 to 11.5, 11.550. It's a zone. So I'm looking for somewhere in here. I think you get beyond the 21, and it's enough to kill the hopes and dreams of people that are short the market and take all their money. And it's enough to get people that are really bullish on the market in. And then maybe you roll over from there. I don't know, but I think that that's the move that's underway. Doesn't have to play out that way, but I will throw out the first time I've ever believed in seasonality, Danny. You sell Rosh Hashanah, you buy Yom Kippur, right? Mm-hmm. And so it's the only time I've ever believed in seasonality. And if I look back on the charts, boy, that one appears to be a pretty big truism. Like Christmas comes, Easter comes. I don't believe in sell in May and go away, but this whole sell Rosh Hashanah, buy Yom Kippur seems to be playing out, maybe to a T. And so, but we'll see. And we've got a lot to talk about between then and
so. Can you say 60% of the time it works every time?
I'd go 72.3 every time. Who was that that would do stuff like that? Not Joe DiMaggio, Joe Garagiola? No.
No, that quote is from Ron Burgundy.
Oh, Yogi Berra is who I was thinking of.
Yeah.
Yeah, it sounds like Yogi Berra.
That does sound like something that Yogi would say. Nobody goes there anymore. It's too crowded.
That's exactly, yeah. When you see a fork in the road, take it. So Don got in. Let me do this because it sets up where I'm heading with the show Rue here. And then Danny, there's a trade in pen that we did this week. If we get to it and you can remind me, I'll talk options here in a second about it after I go through this. But look, stock nerds, market lovers, if you want to get hold of us, go to revereasset.com, and then it's real simple. Here we go, Tim at revereasset, revereasset, Dan at revereasset, and then look, the easiest way to get your questions answered or file a complaint, and this is the complaint department right there, 855-732-5932. But I always tell folks the easiest way to find us is on Twitter. And so here I am at TJ Razor. You'll get stuff like this in your inbox in the morning, in your timeline if you follow me. Don, we're going to talk about this AAI survey here towards the end of the show and its implications for my thesis that we're in an inverted head and shoulders. At the Vanden board is Don's. And then Danny right here talking. We'll get into this if we have time, but it's one Danny Stewart is how you get a hold of us on Twitter. And the reason why I'm telling you about Twitter is because, look, I do answer the emails in my inbox. It just takes me a while to answer said emails in my inbox because you ask very long and detailed questions, and I'm a slow typer. So if you want expedient answers to your questions, you follow me on Twitter, follow Danny on Twitter, follow Don on Twitter, and then you can absolutely positively just message us. And for some of you that hate social media, you hate Twitter, look, use Twitter as your research tool. I can show you how to do that, but use Twitter as a text machine to get to the people you know and love, such as the three of us. Now, Don got into a discussion. Really wasn't a back alley fight. It was a discussion about it was buy and hold, and it had a lot to do with dividend stocks. And Don is a lot of things, but I will tell you, I mean, he thinks that Kiss is a good rock band. Questionable. Yeah, he thinks the Playboy that's on his right hand side right now is a collectible. Questionable.
It's the Gene Simmons edition. It has to be.
He thinks Gordon Minshew is probably better than Carson Wentz.
Well, it's Gardner and it's Minshew.
But could be why I couldn't find him on Twitter. I have the Gardner playing quarterback for the Jaguars.
And I'm in mourning, and it's the black Jaguar shirt today after that debacle on national television last night. We're terrible. Terrible.
Can't be any worse than the Eagles. But I mean, give us a chance to lose to Ryan Fitzpatrick, and we will. But what Don is not is he's not a buy and holder, and there's nobody I would trust more to manage wealth than Don. And I say that because the discussion Don was having, you can find the discussion on Don's Twitter stream with an individual, was about dividend stocks and holding them for 30 years, 20 years, whatever. But in that time, you're going to get 2008 several times. And if you ever invest in Revere Asset as a client, you will never get 2008. There's just no way that happens with our sell discipline, with the rules that we have in place. And so I've got some notes. I want to be really clear here because I'm going to read from the gospel in a second. That's right, Danny. I'm breaking out the Bible here in a moment. But
alert the media.
I've been stewing on this for, I guess, a couple days now, whenever that conversation took place. And I'm going to have to read. I'm going to have to literally read from my notes because I want to be sure I do this in order, because normally I just do everything right. I've got the show notes, but I'm doing it from the consciousness of my very special brain. Just fantastic. I mean, I'm handsome. I'm really smart.
It's special, all right.
Yeah. And so, but
you should donate it to science once you're gone so they can study.
Here's the things that I don't like. The person that Don was talking with, I don't know from Adam. He might be a super nice guy. I don't know. And I want to be really careful that I don't come off as attacking any one person. What I'm attacking or what I'm questioning is an ideology. And that's a big difference. And normally you'll hear me attack Raymond James or Morgan Stanley, and I really do not like those people. So let's just call a spade a spade. Take your dogs to the Morgan Stanley office in Berkshire, near Berkshire Mall in Wyomissing, Pennsylvania, and do what dogs do there. But now an ideology is buy and hold, and you can make a tremendous amount of money if you buy and hold. but and we'll get into this. Now I've got Don concerns like, Tim, what are you saying here? And well, you can. But many presume when you're talking to people like the person that Don was talking to, many presume that you shouldn't be investing if you can't afford to lose the money. And quite frankly, that's just not right. That's an outmoded way of thinking. And now go with me here, boys. I got a whole string here that I'm going to run through, then I'll give you a chance to talk about. The way that our retirement system in America is set up now, you have to be in risk assets. Now, what type of risk assets? That's a whole open to discussion story. But there's no longer the ability to to grow your money so you can then have wealth to secure. It used to be able to do that, but with the advent of low interest rates and the Fed's actions, right, wrong, or indifferent, that's a whole show too about the Fed, that you have to put your money to work. And some of you are like, well, Tim, what are you talking about? Well, think about it with 401ks and IRAs. You're putting that money to work into the markets. What you're putting it in is a completely different story. But with the advent of falling rates and zero rates across the globe, there's no other asset class that can deliver, okay? So then how do you approach that? Like if you get the group that Don was engaging with on Twitter saying, they're well, if you can't afford to lose it, you shouldn't be investing it, because that's their fallback argument when they buy something and it falls 50, 60, 70, 80%. And I'm not being dramatic. That's just what the discussion was centered around a couple of stocks. The argument that they will come back with is, hey, well, you shouldn't invest it if you can't afford to lose it. And I'm telling you that that's just not the way the world works. The real life things that you want to achieve that are advertised, the Wall Street has some of the best marketing, that are advertised in those commercials will never be obtained if you don't step foot into the market. And by the way, you'll never get there if you just index. Indexing makes the people that want to sell you indexing rich. It doesn't make you rich. Indexing lets you worry about how you're going to pay for medical care when you're 75. That's what indexing eventually gets you. It leaves you with just a ton of worries that you wish you would have bought X, Y, and Z stock that everyone always talks about. If you just would have put $10,000 in Amazon, and we'll get there in a second as I proceed with this discussion. So what you need though, how do you participate? How do you grow your wealth and protect it at the same time? You do what Danny, Don, and I do every day here in the shop. You have a set of rules that get you into stocks, and you have a set of rules that get you out. Now, the group that Don was conversing with on Twitter, they don't do that. It's just in. There's no sell. There's no eject. And then they want to then take actions as perversity, where, well, if you're just buying and selling, you're going to miss the moves. No, you won't. And I'm going to talk about that here in a second. If you have rules for entry and rules for exit, you can do what 99.93% of people in this country can't do. Not only grow your wealth, you can preserve it as well. Don, what's the hardest thing about making money?
Keeping it.
I was just about to say.
You have to have sell rules. Anybody.
That's how you keep it.
My mentor said this to me once walking by. Anyone can get you into a stock. How are you going to get out? And boy, those words ring true every day of my life. And so if you take the way, and I'm going to delve a little bit deeper here, if you take the way that we approach the markets, whether it's in an uptrend, a market that's choppy and trading sideways, or in a corrective period, whenever you start buying back in, you will always start from a higher base. So if you lost 30, 35% on a $100,000 account, like what happened in March, you were down to $65,000 if you were the indexer or the person that had some stocks, but they dropped more than the indexes. And if you were with Revere Asset, you're starting somewhere. Danny, what did we drop? in March. What was it, 7 and 8% respectively across the
Between
portfolios?
7 and 8.5%.
7 and 8%. So starting somewhere at $92,000 and $93,000 is a hell of a lot better than starting at 60 or 65,000. Okay, there's just no arguing that, and that's something that we do regularly. We document it. If you want to see how we operate, if you want to see how we make the secret, there's no secrets. We show you everything you do, everything we do. We don't hide, which certainly is tell don't do mutual funds. Mutual funds, it's like mutual funds climbing into the clown car, Danny, and seeing if everyone can get out. That's what mutual funds are. We only do mutual funds in 401ks that we're forced to do mutual funds in. If you want to see, one second. If you want to see how we're doing this, just write it all down, Danny. I'm going to give you an opportunity here. You can see we're like the police, every move we make. Pretty sure that was a creepy song, not a happy song. You can see everything we do. These videos aren't, propaganda to tell you how great we are. This is what we're doing. You guys have Netflix, right?
Yes.
Okay. There's a show on there called The Chef's Table. And this season is about barbecue, and they feature Tootsie from Snow's Barbecue down in is it Georgetown, Texas, Central Texas barbecue. Tootsie's 87, 88 years old, and it's the best. It's been named the best barbecue place in Texas, which is one of the highest honors. And it's only open Saturdays. And it draws, I mean, you got to be there like 5 in the morning, 4 in the morning, and everybody wants a picture with Tootsie. There's a line at the end where it's either Daniel Vaughn from Texas Monthly magazine, or it's the owner of Snow's Barbecue itself, where the voice is saying, you meet a pit master, and the pit master is going to show you everything he or she knows, and they're going to tell you the recipes. But the truth is, you could have all the great rubs, all the great spices, all the great tools in the world, and I'm paraphrasing here. But the difference is the pit master. The difference is the person operating. And nobody can replicate what Tootsie's doing. It's so distinctive, and the quality to which she achieves, how she builds her fires, how she gets the air flowing over the meat, just how she knows how to turn it. There's no temperature gauges, Danny. It's she uses her hand on the outside of the pit to feel if it's hot enough or cooling down, so she knows how much coal to add to the fire. It is an amazing thing to see. And really, in essence,
Dan, is she as good as you at barbecuing? Probably not.
But when I was reading through the timeline of Don's conversation that he was having with this individual, that's the conversation that struck in my head. That people see what we're doing all the time. I've told you what our business model is, stock nerds and market lovers. I've shared it with you. We give you everything, knowing mentally how hard this is. And so we want to be the person that, if you can do this on your own, let us be the person that is helping you achieve greater than what you were doing without us. We want to enable you. We're here for you. We're your teammates. If you find it so difficult to do this on your own, we're here for you too. And thousands and thousands and thousands and thousands and thousands of stock nerds across the globe flock to us because of our transparency and our rules. And when I was reading through Don's timeline, I was struck by the pitmaster analogy with Don. And that's the secret, that we can give you everything. There's no secret to how we're doing it, how we're operating, but you need an experienced person unemotionally operating in the markets. And I've been reading, Danny, well, I shouldn't say I've been reading. I started this book. It's called The Outsiders, not Pony Boy or Ralph Macchio. It's Ralph Macchio, Kevin Bacon, like Matt Dillon, no. The Outsiders is by a guy named William Thorndike, and it's 8 unconventional CEOs and the radically rational blueprint for success. So I had started this. I'm just going to read you a couple things here that are going to make a point that lead to a further point. And I think our way is best for making money in the markets and preserving wealth? I do. If I didn't, I would be doing a different strategy. Someone once asked me, well, aren't you guys diversified? Well, we're diversified amongst the best stocks, and we sell them when they're not the best stocks anymore. We do that. Well, why don't you have banks? Well, because diversification is for preserving wealth. It's not for growing it. And we found a better way to preserve wealth, which is what? Selling. If we're that concerned that the market's going to fall apart, the best way to preserve your wealth isn't by buying the banks, it's by selling.
Well, not being politically correct, banks are dogs right now.
Amy, I think that was the most politically correct thing you could have said about the banks. Jesus. Okay. So I'm going to read this passage to you. Then I've got just two things here ticked off, okay, that I think are really important to the discussion that I'm having with myself, and then we'll invite you to participate in. Someone out there is just yelling, get to the stocks that are going up. Pen and
Tim's talking
DraftKings.
to himself.
Well, that's what I do all day here. In this refreshing counterintuitive book, author William Thorndike brings to bear the analytical wisdom of a successful career in investing, closely evaluating the performance of companies and their leaders. You will meet 8 individualistic CEOs whose firms' average returns outperform the S&P 500 by a factor of 20. Sounds sexy? In other words, an investment of $10,000, which each of these CEOs on average would have been worth over $1.5 million 25 years later. Pretty impressive, right? Now, oh, I got Danny's attention. He's not even breathing. Blink for me. Let me know you're still alive over there.
I'm holding my breath.
Perfect. So now I'm into the book here. Basically, CEOs, and by the way, management is a huge deal with our investment style. We don't talk about management that often, do we, Don?
The management of the portfolio or the management of the company?
Management of the company.
We let our results do the talking for us.
No, not of Revere, of the companies we buy, the stocks that we buy.
Oh, I thought you were talking about Revere. God, I was taking a victory lap.
Oh, you can take a victory lap. Go ahead.
No,
it matters. It matters a big deal.
It shows up in the price of the stock.
There you go. Now,
Exactly.
hold that thought. Hold that thought. So Don has no idea who the hell William Thorndike is. Has not read this book. Doesn't know what I'm going to talk about here. But he just made my point for me. Brian Nichols, the CEO of Chipotle, is the first. It's one of the first times I've ever seen. Well, I saw it with Taco Bell and what he did there, but that was a part of Yum. But you want to talk about the difference that management can make. I mean, someone probably say Tesla. You go through a whole bunch of names that you know. But it's the first time that I'm like, I got to tell the world about this new CEO at Chipotle and why you should be buying Chipotle. So basically, Daniel, CEOs have 5 essential choices for deploying capital. Okay? Investing in existing operations, acquiring other businesses, issuing dividends, paying down debt, or repurchasing stock. And there's 3 alternatives for raising it: tapping internal cash flows, issuing debt, or raising equity. Think of these options collectively as a toolkit. Over the long term, returns for shareholders will be, listen to this part here, Daniel. Over the long term, returns for shareholders will be determined largely by the decisions a CEO makes in choosing which tools to use, which ones to avoid, among the various options. Stated simply, 2 companies with identical operating results and different approaches to allocating capital will derive very different long-term outcomes. I flip the page, I skip a bunch of stuff. Specifically, now there's the former CEO of Teledyne, Singleton. This gentleman focused Teledyne's capital on selective acquisitions and a series of large share repurchases. He was restrained in issuing shares, made frequent use of debt, and did not pay a dividend until the late 1980s. So the bulk of Teledyne's gains, and I haven't told you the story of Teledyne because I don't need to right here. All of that return, that if you would have put $10,000 in Teledyne with Singleton, you would have come out 1.25 million higher. didn't issue a dividend once. In contrast, and Teledyne was a conglomerate. In contrast, the other conglomerates pursued a mirror image allocation strategy, actively issuing shares to buy companies, paying dividends, avoiding share repurchases, and generally using less debt. In short, they deployed a different set of tools with very different results. And now I want to show you a chart of the most widely known conglomerate, General Electric, and we'll take it out 20 years and we'll look at it on a monthly. Danny, this might be the most coherent show I've ever done for you.
I'm following right with you.
Yep. And so you
Let me
can
know when
see,
you want me to clean it up for you.
I'm gonna, you're coming. You can see the disastrous results from 60 to 6, literally 60 to 6. Now, is that all dividend paying stocks? No, it's not. Of course it's not. There's some other bank stocks like that pay dividends, and we can look at those here. You could buy and hold Citigroup, 573. So I don't know if you can see that number, Don. $573 to 42. Okay. I'm only doing the banks because Danny mentioned them. Let's look at Bank of America, 55 to 23. Oh, how about the worst? Wells Fargo, 60. Here you go, 66 just a couple years ago, down to the 23. But I digress. Now,
But you got a 5% dividend.
we'll get into that. Now I'm going to talk from the gospel. Okay, I haven't broke out my edition on this show ever. This is my 4th edition of How to Make Money in Stocks, the one that I love the most. And if you ever want to know where to start in this book, you go chapter 9, page 109, Markets Direction. But I'm going to read to you from the Book of O'Neill, chapter 1, page 4, Psalm 21. Okay. And I've had this tabbed off forever. So let me start here. These are the bullet points in the front, and I, honest to God, have never read these to anyone. I used to, clearly I would quote from the Book of O'Neill often when I was on the road talking to the 40 or 50,000 people that would come see me yearly. And I would share with them the wisdom of the gospel and how they could use it to make money, and I would show them how to practically put it into action. But I think based on the discussion that Don had on Twitter, there is a contingent that if they're open-minded enough, will hear these words and become curious. But I got to share with you another thought, Danny, that if I made motivational posters, I would put my own motivational thoughts on motivational posters and hang them in my house, Danny. That's how conceited I am with my greatness.
Along with your sports cards.
Oh my God, can we talk about that for a second? I mean, honestly.
Sorry, Don, I didn't mean to take a left turn. Ooh,
but
shiny,
here we go.
Shiny.
Here's my thought about the type of person that Don was talking to on Twitter. People defend what defines them, right or wrong, and the market begs you for different. And so this fellow that Don was having a discussion with has built his entire world around buying and holding dividend paying stocks. When he discovers, if he discovers the flaw in buying stocks, holding them forever just because they pay a dividend, which could be taken away, by the way, he will still defend buying and holding dividend paying stocks. Hitler could have financed the Third Reich with dividend paying stocks, but this guy would defend Hitler's use of buy and hold strategies. That's how blind people become, because it defines them. And
this guy has also gone to painstaking levels to remain anonymous. Let's point that out too.
That's a problem too. But let's just pretend that he's known as the dividend master. Is that what that's not what he's known as, is he? I don't think that's his name.
No.
It's something else. Anyway, you can go on Don's Twitter timeline and find it all. Now, think about that in your own life, not Danny and Don, but on your own life on the other side of the microphone here. You defend what defines you. And if what defines you is right and virtuous, well, that's great all day long. But the market does not want you to be that way. The market says if you buy a stock and it sells off like General Electric, you should probably sell it. And there's rules based on that. We cover those every week. I don't need to get into those right now. What gets us to exit markets? What gets us to exit individual equities? You never hear Don, Danny, or I arguing for the validity of a stock because they're either doing what we want or they're not. And if they're not, they're either on the chopping block or they're already cut. It really comes down to that. And so I don't defend stocks. I don't defend markets. The stocks in the portfolio don't define me. They don't define Don. But it was really interesting to see this person. And I keep saying, gentlemen, I don't know if it's a man or a woman because their identity is hidden. Buying and holding stocks clearly defines this person. And if you follow people blindly like this and you blindly defend things, you'll fall into the trap. And before you know it, Bob's your uncle, you're not going to ever meet the goals you set financially. But that, by the way, the people defend what defines them blindly. That can go to a whole other subset of your life. And I don't approach it that way. Like the market humbles you. The market will absolutely positively, squarely humble you every opportunity. You know, there's 265 trading days, and I swear the market wants to humble you 266 of them. And so it comes back for one more on the weekends just to make sure if you didn't get enough during the 5 days of the week. So William O'Neill, my mentor, the person who hired me right out of the Marine Corps, says, when I started investing, I made most of the same mistakes you've probably made. But here's what I've learned. You should buy stocks when they're on the way up in price, not on the way down. And when you buy more, you do it only after the stock has risen from your purchase price, not after it's fallen below it. You buy stocks when they're nearer to their highs for the year, not when they've sunk so low that they look cheap. You buy higher price stocks rather than lower price stocks. You learn to only sell stocks quickly, rather have a small loss than waiting and hoping they'll come back. You pay, now this is the one, you pay far less attention to a company's book value, dividends, or PE ratio, which for the last 100 years have had little predictive value in spotting America's most successful companies, and focus instead more on important proven factors such as profit growth, price, and volume, and whether the company is the #1 profit leader in its field with a superior product. All of these vital actions are completely contrary to human nature. In reality, the stock market is human nature and crowd psychology on daily display. Plus the age-old law of supply and demand at work. Because these factors have remained the same over time, it is remarkable but true that chart patterns are just the same today as they were 50 years ago or even 100 years ago. Few investors know or understand this. It can be used to an inspiring advantage. You'll probably find a whole new way. Now he's talking about his book here, but if you just follow what Don, Danny, and I do on the podcast, this next part applies. And then I'll open it up. You'll probably find a whole new way of looking at America and its stock market if you follow the things I'm talking about. From the railroad to the auto and the airplane, from the radio to TV and computers, from jetliners to space exploration, from massive discount stores to semiconductors and the internet, this country has shown rapid, unceasing growth. Living standards for the great majority of Americans have improved materially from where they were 150 or even 30 years ago. Yes, there will always be problems, and everyone likes to criticize. But America's innovators, entrepreneurs, and inventors have been major driving force behind its unparalleled growth. They have created the new industries, new technologies, new products, new services, and most of the jobs from which we have all benefited. So then think about that with the buy and hold mentality, okay? Think about that. The stocks that the gentleman Don was talking about, a lot of it focused in and around General Electric. None of that describes GE. But if I put Amazon on here, people love to cite Amazon, but there are a million ways to approach Amazon. If you are the person that when you invest, it doesn't matter if you lose the $10,000 that is always used because it's just a nice round number, right? If you put $10,000 in Amazon, Microsoft, Home Depot, pick any stock, you would have this much money. But for most Americans, that $10,000 matters. That $10,000 is the nucleus that's going to fuel educations for your children. It's going to fuel the ability to pay for health care as an elder. It's going to be the driving force between having your parents be able to stay in their home or having to put them in maybe substandard care to what you would like. And it's gut wrenching. And so there are multiple times in the 20+ year journey of Amazon where Amazon lost almost all of its value. But nobody wants to talk about that. But with us and those that practice the gospel, you can always get back into Amazon. Just because, see, the ideology of it's a perversity that the person has that Don was talking with. Because once you sell a stock, you can't get back into it. Who said? Why? If you sell a market, you can't get back into it. Why is everything so black and white? And I come back to my very original thought, created while I was staring at myself in the mirror going, God, I'm handsome. People defend what defines them. It's why you can't get back into Tesla and get out of Tesla. I'm in Tesla, ride or die. HODL. Hold on for dear life is what HODL stands for. Why? Why can't you? If I have an opinion on the market, if Don has a bearish opinion on the market and the market comes back up and wants to go to new highs, do you think Don, when it looks like it's going to go back to new highs, is going to keep holding on to this bearish opinion? That doesn't make Don weak. It makes him smart. But the way arguments in America are shaped, the market is not the typical thing. If you're against something, most people are against arson. I'm picking arson and something not political. Everybody's against arson, right? Like everybody's against arson. No one's going to come out. Very few people are going to come out and go, I'm pro fire starter. And so if you're pro, if everybody's against arson, you can hold that belief for the next a gazillion years. But if you're against Amazon right now because the chart doesn't look good, you have the ability to change your mind, and it doesn't reduce you as a person on the inside. But if you're the person who constantly defends what defines you, you are so effed as an investor, and it's why you get middling results. It's why you come out and say, buy the banks, they look cheap. If you defend what defines you, what eventually is going to happen is people will figure out the fraudster that you are. You might not be committing fraud in the law and order sense. You'll be committing ineptitude fraud. You'll be committing fortitude fraud. You'll be a fraud to everyone around you. How can you defend? Like it was astounding to me how you can defend just buying and holding and wasting people's money like this. And it goes back to the thought that the only people that get rich, I'm not saying that don't make money, but get rich. Well, Tim, how much is enough? If you want to have a wealth discussion, that's a whole other show, folks. The only people getting wealthy are the people that sell you buy and hold strategies. It sure as hell isn't you. And when you come to the realization, I watched a parade of people when I was working at the office, but now because of Corona, I like to stay in the safety of Nora's room. So now, Danny, you can't text during the show. I actually read it.
That was meant for Don, not you.
Yeah, I know.
Let
I'm
me-
on the text string.
I'd like to jump in here a little bit.
1 second, just one second. Let me
Well, you said
belabor the
that 20
point.
minutes ago.
I know, but I'm hedging my bets here that I've got more brilliance. So
I bought a put on that.
you brought the funny today.
Oh, man. Well, I got some really good comments, Tim. You're not the only one.
I'll tell you what, you can make them. Go ahead, make them.
What made you decide to buy a put and not sell a call, Dan?
Yeah. Well, either way. So a lot of what you're saying, it just rings so true because it really is the marketing spin of Wall Street. So think about what Tim says there. He's talking about don't defend your stocks. That's all all Wall Street is doing. So he used that quote, don't invest the money, you can't afford to lose it. But the market always goes up, always comes back. Well, aren't those opposite? Aren't those opposite things? I mean, how are you going to lose it if it always comes back? It either always comes back and you don't lose it, or you can't afford to lose it. So those are hypocritical. I also don't like that fact, well, if you just had Amazon and invested $10,000 when it went IPO, that's hindsight. And you're right, Tim, that went almost lost 90%, 70%, 97% of its value 3 different times, almost went broke. Now think about this. How would you have known to do Amazon? When they went public, they were online selling books. They were an online bookseller. Are you really? Now, remember Triple D? Triple D was printing 3D printers. Now, if you're thinking about it at the beginning, what makes more sense to you for changing the world and innovation? Online 3D printing that can print organs and cars and everything, or someone who's a retailer who's selling online books? Nobody knew they were going to morph in and be the great company that they are today. So that whole thing is just a big farce. It's just all marketing, and it's a big lie.
I want to reiterate. Take a pause for a second. I want to reiterate what Thorndike is citing in his research, and what O'Neill knew. A lot of people don't know the story of Bill O'Neill, but quite concisely, he was the first person to use computers to figure out the 7 common traits that great stocks had before they make their biggest price moves. He's the master of technical analysis. It's not witchcraft or voodoo. He's just the most plain-spoken person you could ever meet, but he's also plain-spoken in his strategy as well, and straightforward. Wonderful book if you ever pick it up. Companies that make you wealthy do not pay dividends. They invest in themselves. They put the money right back to work. They issue debt to put the money right back to work. In this particular case, saying that a lot of people thinking that you can grow wealth in dividend paying stocks, you need the growth component. It doesn't mean those prices don't go up. But the hardest thing to measure is the opportunity lost cost. And everybody wants Apple. Apple's a great growth and dividend story. It's one of the few. And I'm quite sure I'll get flooded with emails. Well, what about this stock and this stock? It's the same rationale that people will hear what they want to hear. When I say that the only people getting rich, only people making true wealth, are people that sell you indexing strategies. And the reason why that is because you actually need the money at some point. If you're an indexer, you're 100% in 100% of the time, which is the most risky thing you can do in any market. It's akin to saying, I have that car pedal to the metal no matter where I'm driving. Well, sometimes you're driving in a neighborhood, which is 35 miles per hour. Sometimes you're in a school zone, 20 miles per hour. But when you're in an index strategy, you're 100% in 100% of the time. And what they don't tell you, what Rick Ferry won't tell you, and some other reasons of indexing, what they won't tell you is that you're going to need the money sometime. So what do you do about that? Well, it's like roulette. You just hope to God it isn't in 99 or 2000. It isn't in 2001. You don't need the money in 08, 09. Well, if they didn't get out, Tim, they would have been just fine. Well, sometimes you have a college payment. Sometimes your parents come down with dementia and you want to get them the best care possible. Sometimes you need the money. But if you're in those once in a lifetime events, that how many times, Danny, in the last 20 years have once in a lifetime events happened?
At least 4.
4. You're effed. And you just took 30% off. And that 30% can make all the difference in the world. I'll tell you what. Now, I'm not here to convince anybody of what we do is right and virtuous. It's not my role in life. My role in life is to hopefully help grow our clients' wealth and protect it. And then I want to inspire individual investors with strategy and help and mentorship. And by the way, when you email me or you text me on the Twitter machine, I get the same back from you, more in spades than I ever give you. Your questions spur so much deep thought for me that I could never say thank you enough. That's the little known secret, that when you email and reach out to us, your thoughts, your questions, your cares, your concerns, they make us so much better. So please keep doing it. Please do. But you don't know a strategy. When someone sells you a long-term strategy, the problem with it at the end of the day is you didn't know it didn't work until it's too late.
Well, look, just like bonds, long-term bonds have more risk. The longer your strategy, the more risk you introduce, because there's too many things that can come out of left field and knock it off. Now, let's talk about your dividend strategy and philosophy and all that stuff you were talking about. All right, it's so the economic theory, the life cycle of a company. When a company's early on in strong growth mode, it doesn't want to pay a dividend because it wants to plow the profits back into the company and have rapid growth. In fact, it shouldn't pay. The only reason a company should pay a dividend is if it doesn't have better use for the money, the profits, to reinvest, and they can't grow it well enough, so they will pay you a dividend. So really, the only dividend paying companies should be older, mature, they're making a lot of money, cash cow companies, but they have not a lot of growth prospects, like utilities, whatever. And so what Bill O'Neill realized is you can make a lot more money with higher growth companies in their first, second, third stage, and get in those. And then once they become a mature company, there'll be new technology and innovation coming down the pike. And as long as you have a sell discipline, so you don't get creamed by just 1 or 2 companies, you can make much more money with less risk, even because you got a sell discipline. So it's not worth the dividend. The dividend, especially if you're going to buy it whole, because if a dividend's paying 5% and it's down 30, you're down 25%. You're not making money.
And people normally, it's interesting, Danny, and we should probably get Don's opinion here in a second. The only thing, like people say, well, I bought some stock and I just threw it in the drawer, the proverbial drawer where you put the old stock certificates, and I just let it sit there. And that's great if you have the means to do that. And if it goes to zero, it's not going to affect you. That's not the way it is for like 90% of Americans. That's why the 401k system and the retirement system is set up the way it is. If America's 401ks and retirement system, the markets, people complain, Danny, well, Jay Powell's propping up the markets. Do you realize the destruction that would happen to people's abilities to actually not even just exist on retirement if the markets just collapsed?
Well, 401ks are propping up the markets. It's like, you got to stay into those mutual funds.
There's a whole reason why. That's a whole different show, whether you agree with it or not, that Jay Powell is buying the debt of companies that probably don't need him buying the debt. He's propping up the whole market, because if this whole retirement system, you think Social Security is going to, everybody knows Social Security isn't what it was designed or supposed to be. And if this system falls and craters, we're in something that's probably, I would imagine, twice the magnitude of the Great Depression, because that's the way our system is set up, right? Like it or not. And so it astounds me that I don't want to belabor this point. I was about to belabor it a little bit more, Danny, but we should get Don's thoughts real quick.
I always, whenever we talk about something or have a theory, I always attempt to quantify it. With having my IT background, one of the sayings was you can't measure what you can't track, you can't manage what you can't measure. So quite simply, dividend stocks are not going to shield you from a downtrend in the market. In fact, they're going to be basically right in line with the S&P 500. And here are some stats. The S&P 500 dropped 34% from its peak on 219 of this year to its low of 323. Now let's take a look at some quote unquote dividend protective things that you could have had your money in. Okay. Let's go with the Dow that pays a slightly higher dividend. And all of these things I'm talking about.
You talking about Dow, the company?
No. Dow Jones Industrial Average. All these things are paying a dividend between 1.8 and 2.1%. That's the dividend that you can get from quality stocks these days. The Dow Jones Industrial Average was down 37%. Noble, N-O-B-L, this is a dividend aristocrat, a collection of the best dividend stocks in the country, was down 35%. A minimum volatility ETF that pays a dividend was down 33%. The real estate in
what's that ticker, Don?
USMV is the minimum volatility. NOBL is the dividend aristocrat.
I got Noble.
XLRE, real estate, down 38%. The value MSCI factor, down 39%. The S&P 500 value component, down 37%. And the best ticker? One, that's VLUE and IVE.
Okay.
And the best one, the Vanguard Dividend Appreciation ETF, ticker VIG, which I own in the blue chip growth and income portfolio that I run, but did not own during this downtrend because it hit my stop, was only down 32%. So it did beat the S&P 500 by 200 basis points.
But here's a takeaway. All those, quote, safer, lower volatility, dividend paying stocks that are supposed to make people comfortable, big blue chips, were down just as much as the index. They correlated almost 1-to-1. In fact, the one that was down the less actually had a little bit of a growth component to it. And that's one of the reasons it weathered a little bit better. But that's why you need to sell discipline no matter what you own, growth, dividend. And it's all semantics.
If a company's paying a 37% dividend, they're probably not going to be in existence too much longer. There's a reason. There's a reason why. Danny, what I was going to say, I had forgotten my thought. The only thing that I believe you can put in a drawer and just stash it away, that's how I treat sports cards. Like I just, sometimes I flip them on eBay just because I like trading. But like, I don't know if this Luka fella is going to turn out to be the next Michael Jordan, but if he is, I got 3 of his cards there that I picked up in different packs. You know, I'll put that stuff away, and I really do think sports cards and memorabilia, it's a shame you don't have your concert tickets on because that stuff is selling. Like, you know what? Like it's crazy. Like it's this generation's art. Like people mail in, Danny. People, I think it was $20,000 or maybe it was $100 for original Nintendo Mario cartridges. Like they'll you can send them an original if you have them and they're not that bad. Like you can send them and get them graded. People are buying them. Like that's the generation that grew up with Atari and that grew up with Mario. Like it's this generation's artwork. It's their Monet, you know, or Renoir. Like and I don't know if that stuff drops in value.
Or Ric Flair. It's their Ric Flair.
Ric Flair was in the package and Don mailed it in to Beckett or PSA to get graded. Yeah, like they'll assign it a number based on condition, and I'm telling you, there is a market for it. Like that's what sports cards are to me, and why I enjoy it. Like I don't feel the need to you know, like you could chart. I actually went to a startup conference where these kids from A&M, Danny, they started a marketplace. There's a couple of them now, but They started the marketplace for sports cards and charting value. The most I wish eBay, if I was going to give advice to eBay, gosh, I should start this company. You know what? I'm going to say the idea out loud, and then I'm going to start it. If eBay would chart the prices, because eBay's the marketplace where there's enough volume, like there's enough liquidity for a number of cards. You could chart the value just like you do stocks. I mean, granted, it's not instantaneous, but it's getting to that place where you're going to see fractional, well, you see it now, but you're going to see more fractional ownership of sports cards, where somebody has a sports card, it's held at the Bank of Don. Like, let's say Don was the vault, right?
Held in trust. And you split it up.
Don will hold the cards in trust, and then if it's a Wilt Chamberlain rookie that sells for $500,000, that card's held in trust, and then like Don can offer that card up to 20 different people, or the seller who owns the card can offer up chunks of it, and it's just held in trust. And I think that's where sports cards are headed. Just like they had to break up, the worst thing that could happen to the fractional share market is Tesla and Apple splitting. They needed them to stay sky high, like Chipotle, like Amazon is doing, or when Priceline with his Booking.com, whenever that thing was flying high. But that's the things. Those are the things that I'll put in a drawer. And if the Luka Doncic, I don't even know how to pronounce his last name properly, Luka D, Dallas Maverick, who maybe I'm a fan, maybe I'm not, I don't know. If he turns out to be great, I'm going to send all these cards to get graded, and if they're great, great. If not, it's whatevs. But that's not the way I feel about stocks. Stocks are a business, man. Collecting is something different, and I think people confuse the two. Buy and hold is a collector, but there's no investor in the world that would describe themselves as a collector. They say, I'm an investor. And it's like, well, you've got some dog blank stuff when you own the banks and GE and Noble and everything else that Don just talked about. That's not investing, that's hoping that it's worth more than when you bought it, when it comes time. And the dividend is used as this almost like hallucinogenic drug. It's LSD. You're getting paid to wait. Oh my gosh, you're getting. I mean, that's like.
Well, when the dividend's paid, it goes ex-dividend. So normally the price will, theoretically drop.
You can't talk like that. You can't talk that sense into people, Danny. And that's what I mean. Like, I just don't think. I think there's very few people that can quantify. And that's why I wanted to do the show this way. So the best thing that happened was Don went into the back alley and found a fight. Found a fight. Yeah. And I was going to say found a fought, but found a fought is not good English, Danny. It's found a fight. And then it helps illustrate and quantify what it is that we're doing and why it's so different. And look, I don't think we're better than people who buy and hold. I don't want you to get that impression, but people will hear what they want to hear. I suffer from this all the time. Had somebody once tell me that I called for a Dow drop to 15,000. Never uttered the words, never even close. But you're going to hear what you want to hear. And so I'm used to it. We're not better. We just think this strategy is best for 99.93% of investors out there. If you're part of that small minority that doesn't care and can take a shot, that's venture capitalism. That's what venture capitalists do.
Well, buy and hold carries more risk. I will say that. I think buy and hold carries a lot more risk.
And what venture capitalists do is they have a portfolio of companies knowing that 80% of them are not going to make it. I mean,
they just want to get the one or two shops or.
Yeah, one of them is going to be a home run. One of them is going to break even, and the rest are not going to do anything. And they don't know which one. If you want to be a venture capitalist, at least call yourself that. If you want to be a collector, at least call yourself that. Buying Citigroup buying Wells Fargo or buying the MSCI and calling yourself an investor, you clearly don't understand what drives stock price higher, and you'll never know if you don't open yourself up to a different way of looking at it. But people, I go back to probably the most brilliant thing I've ever written. People defend what defines them. And it's great if you're against arson. It's horrible if you're trying to make money in the stock market. Absolutely, positively. So if you have any questions on that, or you think I misspoke, or you don't agree with my worldview, let me once again show you where you can absolutely positively complain. Right here. Right there. That is one Danny Stewart on Twitter and at dan@reviewasset.com. I only take compliments and how you do's, and then Don is always looking for a good conversation. So Don at Review Asset, the easiest thing to do is to call us and yell in the phone your complaint. Just start yelling, and then that would be fantastic as well. You can absolutely do that too. Or if you'd like to join us on the journey and become a client of the firm, I'd love that as well. It's really simple. It's a DocuSign form away, DOCU form away, and it's super duper simple. And by the way, Don, how do you spell assume?
ASSUME.
ED.
The assumptions. I know that Don has somebody on the ropes when the assumptions just start flying out. And I just laugh. Like, our fees are so incredibly low. You have to call to find out. Like, there's things that we can say in a video, there's things that we can't say. You have to talk to the chief investment officer. Danny, I don't know where I'm drawing that arrow. Hold on, right there, because I was drawing it on the cameras right there. The way that I have my, oh, is it? Okay, the way I'm looking at it, it is, yeah. You have to talk to him, okay?
There was a misnomer in that thread that we charge a 20% performance fee. We do not charge a 20%. The performance fee is zero. Yeah. We don't charge it.
We perform as a bonus, unlike indexing. What's the S&P up this year, Don?
1.5% right now.
There you go. That's what you're getting at a bank. Are you getting 1.5% of any bank?
No, I don't think so. Maybe a long-term CD. Dan,
there you go.
You know the rates better than I do.
Probably. I haven't called in a few months because I wouldn't do it. But last time I called, they were below 1.5.
Okay, so 1.5%. Now that could change. That could go up. That could go down. The opportunity cost is what they never want to talk about. We also don't do mutual funds unless a 401k restricts us. We manage a ton of 401ks. Sometimes the 401ks restrict in what we can do. In that case, we do have to use mutual funds, but it's not a pie chart, and you get all the same service that we provide with our equity investors and our ETFs. But if you read through the timeline of Don's timeline, there are gonna be a ton of people looking at you, Don, this weekend. If you read through Don's timeline, you will see the assumption machine, and it really is what social media has unfortunately become for so many. Just full of fake news, just full of it. And so it really is a shame, but it goes back to my original thought that you defend what defines you, and some people do it blindly, unfortunately. And if you do it with the markets, I swear to you, you'll end up blowing up your account. Or if you don't blow up your account, you will wake up at 65. This is what I was going to say earlier, Danny, and it escaped me because you sent a text over. When I would go to the office and I'm sitting in there, and a parade of people over the years comes by. When the folks that are closer to the retirement, if you want to see what sheer terror looks like, and I'm not being facetious when I say this, and my heart bleeds, there are so many people that come through that door that realized it wasn't that they have no investing acumen, that it was the company's matching and their own dollars that were fueling their 401k growth. It wasn't because they were doing well. And when the company stopped putting money in the account, and when they stopped investing in themselves through their paychecks because they were retired, fear effing terror comes across their face because they realized there's no one to paper over the mistakes anymore. And it's scary. And when people realize that the strategy they employ is got a ton of risk associated with it, that's when they would come see us.
Yeah,
Now
not
it's a
enough
different,
growth and no downside protection,
yeah.
both.
Now it's a
Run
different
out of
story.
money and
People are beating down the door to come on board, and we're grateful for that, stock nerds and market lovers. We don't advertise. Like, we have exponential growth because of you, because you trust us and you're sending your parents and your loved ones to us, and we're grateful for that. But my heart, if you want to know why I take such a hard stance and why I'm so articulate about this one topic, it's because I've seen the parade of sorrow walk across my office door to go sit down with Danny, and people just explaining how scared they are, and they can't do one thing. And every time they try to do one thing, it fails. And then when they fail, they take more risk and more risk. And it's like, it almost becomes a martingale situation, not Wink from Tic-Tac-Toe, but where you keep doubling down, keep doubling down, keep doubling down. And before you know it, your account's at zero. You like that analogy, Dan?
I was trying to figure out who that is. Wink from Tic-Tac-Toe. I don't.
Wink Martindale.
What? Jesus, Danny. Now I got to go to the Google machine. I can't really. Wink Martindale. Here we go. Really no images? Oh, there's Wink. Tic-Tac-Toe. Let's get an image. Let's go. Here, Danny, this is
I
Tic-Tac.
remember the dating go. Okay.
That's Wink Martindale, man. Wink Martindale is one of the most famous. I can't believe you don't know who Wink. Jeez.
No, I know that. I see that. I see him. I don't think I've ever seen Tic-Tac-Toe, though. We used to watch The Dating Game and Hollywood Squares and some of these other ones, but I don't think I've ever seen Tic-Tac-Toe.
Also, High Rollers and Gambit. Other game shows that he did. High Rollers. Alex Trebek did that first.
Maybe
really?
Maybe I did see that. All right. Let's get to the markets. Let's talk. Let's actually show people how we do things.
Okay, because I was just going to let for the rest of the show let that episode run.
Yeah, no, that's okay.
Don, what do you got? Let's go to Don.
I got. It's Friday. It is 2 p.m. Eastern time, 2 hours to the close, and my video Thursday night was about how the new leaders got smacked. But today it's bizarro. It's the opposite. The new leaders are really acting well today. I'm talking about Zoom. I'm talking about Beyond Meat, Penn, DraftKings, Fastly, new position I picked up today, Square, Tesla, Pinterest.
That is a beautiful chart. You know, I didn't see today's. I looked at this earlier. Man, that is a beautiful chart of DraftKings right there. Do you see that, Don? That wants more. That chart right there. Full
disclosure, we bought that yesterday for the stock and ETF.
Yeah, we bought it down here off the 21, but I'm not saying it because we bought it. I hadn't seen that. Let's take that down to a 195. I'm sorry. Look at this, Don. Jeez Louise. God,
I bought that on 9/14.
Oh, let me go back to that. Don saw this. That's a 78-minute chart. Boy, is that pretty. That is going to 62. 9/3, Don?
9/14.
9/14. 9/9. Right here. Oh, off that big thrust.
Yep.
That's the ESPN deal.
That is correct.
Yep. That's the ESPN. Yep. That look at that. And so look at this flat consolidation. Oh my gosh. Now look, maybe it comes up here, does one more down here. This oscillation is beautiful. This is exactly what you want to see. This is the quintessential stocks making new highs tend to go higher when fueled by the 7 common traits that William O'Neill identified before stocks make their biggest price moves. Just beautiful. I'm sorry, Don, what other charts did you have? That one, I was just thumbing through while you were talking. What else you got?
We want to talk about moves that we did this week?
Yeah, give me a second. I want to talk two things. I'll forget. And I want to, you just mentioned Penn.
Lot went on this week.
Yeah, so let's look at VX. So I want to do volatility futures real quick. So the VIX continues to be the worst product I think you could use to hedge, even though the volatility futures, that's a daily chart of them. But someone asked, hey, Tim, the volatility futures are inverted. Am I looking at it correctly? And let me just explain to people how to look at it. And then, Danny, do you mind if I show a pen trade that I did off of the, just an idea that I did? Do you mind if I show that? Or you can have, you can say no, don't show it.
You can do that if you want.
Okay.
This is not for clients. You're doing this on your own.
Yeah, I just want to show people because I know a lot of the people trade options and that watch the videos. Here's volatility futures. This is the October contract, very valid contract. It's got more than 3 weeks left on it. And so trading at 31.55. The Novembers are trading at 33.10. So you're not inverted here. Now, where the inversion is or lies is on the November to December, but that's existed now for about a month and a half, where this contract has been pricing over this contract, and this has everything to do with the election. I'm going to be more concerned, and this, by the way, the volatility futures were not inverted, this whole pullback in the markets, which is interesting to me. That's why I haven't been just
super bearish.
Died. What's that?
Super bearish. You haven't been super
yeah, like that's one of the reasons. I've seen it enough times that just because I've seen it enough times doesn't mean it's always going to work. But this hasn't inverted over this, and so it's why I haven't been super bearish. But with Penn, so I picked up Penn yesterday. Here's yesterday off the 21. They issued I didn't know they issued a secondary, Don. I just saw
that's why it plunged yesterday on the. But stop.
I can't
right where you want it to stop. The 21E.
Yeah, I can't. I can't remember a time where a stock has gone up like this, 10% after a secondary.
It's a very good sign.
Yeah, like it's a rarity. So I bought it. Danny, I said, Danny, I want to get bullish. Yeah. I called Danny. I go, Danny, I want to get positions in Penn and DraftKings. And he goes, Penn's down. I'm like, yeah, that's what I'm hoping for. Like I needed, why will this not go back? We might be.
Yeah, it was down about 3.5%, 4%. I was looking at it.
Like it stopped here. That's not a great close either, by the way. But I was just hoping it would make its way back to the 8 and see if it could challenge this. This is more than I would have hoped for in a single day. And so what I did was there's always risk, but there's different things you can do. And so right here, someone's gonna say, well, Tim, it's up almost over 9%. You're only up $100. So I did this in this account this morning for myself. And so what I did here is I went out, and when you see a move happening like that, I bought. These are next week's. These are really short dated, so I'm not sure. I should have given myself more time, to be honest. I bought the Delta 30s, and then I sold the Delta. These were Delta 10s at the time. So I'm buying. So this is a bull credit spread. So I bought the 30s, and I'm selling the 20s. And what that allows you to do, and Danny, you can translate all this in a second. So what did I do? I risked $400 now to make a potential max profit of $2,200. That is what I would call fantastic risk reward. Now, am I going to get $2,200? No, probably not. I mean, to get that, you've got to settle. You got to settle right at a specific price point. I'm hoping to capture anywhere from 60 to 70% of that move. Someone would say, why even mess around with this? It's for the person who doesn't have a large account that follows our work. These are lower cost strategies. And then when I say cost, I'm really trying to choose my words here carefully, Dan, because everything has risk when you're in the markets. And where would I stop myself out at? I typically, if I lose half of the premium paid, lose half of the $400, I mean, I'm left with $200. You know what I'm going to do? I'm going to recapture the premium, and then I'm going to move on. That's typically what I do. There's a lot of options traders that will say you risk the premium paid based on your own risk tolerances, and so you could do that as well and give the chance. But I should have gone out 14 days. I don't know why I actually did 7 days. I wish I would have gone out 14.
Speaking of options and our approach, you know who made their debut on IBD Live yesterday?
Who's that?
Harold, what's his last name?
Harold Morris, man.
Harold Morris. Great addition to IBD Live. Talked about
Harold Morris is
really good guy. Trades only options.
Oh, he moved to only options. I'm not being facetious.
That's what he said. Yeah, he said he really only trades options.
I'll tell you a story about Harold. So Harold and I are very close, which doesn't sound like we're close at all when I go, oh, we only trade options. But Harold and I have a very close relationship.
And I'm breaking the news to you that he's on IBD Live?
Yeah, I didn't know that. Harold is, he's wise. Like Harold is extremely wise. And Harold is, when I say that Harold's calling isn't investing, like his first calling wasn't investing. Harold is one of the people that you read about in success stories of Investors Business Daily who put his kids through school by buying and selling stock. Harold is where I would listen to what Harold was doing and how he was achieving what he wanted to achieve with stock. And it really inspired me to let people know what's possible. And it's, look, people, well, of course you can pay for things with things that you make in the markets. And no, but this is a real human being that's lived a life. Harold, I believe, he doesn't look it, but I think he's 62 or 63. He doesn't look it one bit. And he has lived a life through the markets, which I find amazing. He's the everyman investor, every woman investor. And if you don't know who Harold Morris is, how do they find him now? Is it on Investors Live?
The IBD Live 1 hour show or 90-minute show that they do in the morning. It's a subscription.
Yeah. I mean, he's an amazing human being.
And if you're a fledgling canceling person, there is no better investment. And I don't care if you work full time. If you want to commit to doing this, you have to learn from people that are doing it. And the way they comment real time in the charts and nuggets from William O'Neill and chart nuggets from people that are doing it. They work for the company that has produced the system. There's no better investment of time and money than to watch IBD Live replays.
So, but I didn't know Harold. That's great news about Harold. And so this is just one way. Like most people want to buy calls and puts, but buying debit spreads, like I think that's enough. I don't need to show them what else I'm doing. That'll just detract. All right, Don, what else you got?
Hang on. I want to make a point. So if you do an options, you really got to learn because they are risky. You've got to really control your risk. And the one thing you want to do is you never want to leave a spread open to expiration. You want to. Do you want to tell that story, Danny? No. You want to. Well, it wasn't mine. It was somebody else.
But I think it's valuable. But explain why.
Well, all right. So someone that we know did a spread, and they were in the money at expiration, and the place they were at, Robinhood, had a policy where they would buy back and unwind it going into the close if they were in the money. And they were in, it was on a Tesla spread, and they were in the money significantly. And so they thought that they would just get closed out and keep everything was fine. Well, Tesla, it announced that Tesla wasn't going to pass get added to the S&P 500. And so after the close, and so Tesla had a huge drop. And so you can, at some brokerage firms, you can actually call up, even though it's at the close price, they determine whether it's in the money or not, because they get automatically exercised. You can call them, say, look, I don't want to get exercised. Don't exercise me. And you can do a kind of a manual contra exercise and stop it. And so he actually got exercised his long call. So all of a sudden he got the stock put to him, but his short, that was his protection, he didn't get exercised. So he didn't have the protection. He owned Tesla stock. It gapped down the next day, and it just premium.
Well, that was the.
And now they're arguing about it. They may get their money. Robinhood may be caving.
That was the Friday. That was the Friday where Tesla did not get accepted into the S&P, and Tesla dropped precipitously. And that it's so rare that happens, but when it does, it can be.
But the point, and it doesn't happen often. But the point is, you think
close your trade.
You think that the Friday of expiration, that cutoff is the close of the market. That's the price. It can trade after hours, and some brokerage firms will allow you to go decline even it's past the deadline, a half hour, whatever. So always close out your positions before expiration on something like spread.
Yeah. You know what, Danny, you said that. I've got a Tesla spread on this week that I need to close out today.
Tim, I'm hearing an echo. I'm hearing an echo of your voice. Do you have a mic on somewhere else?
Nothing.
Actually, I'm hearing it on mine too.
Yeah, I'm not hearing anything.
You're not hearing it? Okay.
No, it's on you, Don, I believe. I'm sorry. So yeah, I've got a spread, Danny. I need to close out. I absolutely do. We'll see it. Well, I do hear that, Don. Danny, did you put a speaker?
It's contagion. I haven't done anything.
No, I didn't think it. Don,
I don't hear the echo. It's you guys. Huh?
Let me count real quick. 1, 2. Did it go away, Don?
Yeah, it did all of a sudden. No, yeah, but I can hear. I'm echoing.
Yeah, there's something got turned on your end. Do you want me to give you a second?
Hold on.
That's muted.
Yep.
You're on mute.
He knows. All right. Well, let's continue on then. Don, are you still with us? You can hear us, right? Yeah, I thought so. Yeah, there's something going on Don's end. It'll fix itself, as all the gremlins do. Let's do this. Danny, I've got spotting terms. I did VIX futures. Oh, spotting entries. Let's talk about that real quick. Someone emailed in with spotting entries here, and so how do you? It was a stock nerd that follows us, and he said, "I'm having trouble picking." Don, did you put on the mood lights in your office? It looks purple now.
I'm rebooting to see if. Hello.
Yeah,
so now it's not. Now it's not echoing.
We can hear you.
Okay, I was going to reboot, but that's one of the giant screens was off, so that's what that was.
Oh, it looks like you actually put on the lights that grow.
Yeah, it's just the blue back. No, that's in a different room.
Oh, okay. I'll tell you what, Don, you wanted to go through. So I was going to go through. Let me do this real quick, and then we'll go through the trades. I'll tell you what, let me do this real quick. Danny, take us out, and then we'll go through moves. So the stock nerd wanted to know about spotting buy points and entering. And so it depends really easy here. When you're looking at the 21 exponential, that's a low risk entry point. It feels uncomfortable, but this is a leading stock that's found support at the 21, and you'll know it's not acting right. It meets the fundamental and technical criteria to which we follow in the shop. But if it starts closing once or twice below the 21, you could just sell and get out. Or if you have your stop, this is a little bit lower for me, but wherever your stop is, that's where you would get out. But it comes down to position sizing. So I have been purposely taking 2.5%, 3% positions for like a month and a half, 2 months now, just because I want to give things wider stops in a volatile market. And then, if we're doing an ETF, maybe 5 or 10%, but position sizing is always going to be your weapon. But if you're looking to find, like, how do you catch a turn? You gotta take it down to smaller time frame charts. And let me just remove these drawings here. And so like here is a 30, you know what, the NASDAQ futures are what I use, but we can put it on the Qs because most people don't trade the futures. So here's Thursday. And what is this a turn now? You got to take your signals off the chart you're trading from. You know, here's the 5 coming through the 21 right at the end of the day. But then look at where we end, and then here's Friday's start. If you're like, well, I'd like to try to establish again, the 5 coming through the 8 coming through the 21. That's how turns start. And I typically don't look at positions when I want to take them. I'll use 15-minute charts, but I'm looking at 30-minute charts to spot bigger turns that may lead to more. But look, if you're taking a signal off of an hourly chart or a 78-minute chart, it's the same thing. And so many people worry that they're going to miss it or miss the bottom. You're just looking to spot turns and use size as your weapon. But I want to find a chart set here real quick. Where is this?
So very quickly, what Tim is saying is, if the shorter term moving average is slicing up through the midterm moving average on whatever time frame he is, that means shorter term momentum is overtaking and stronger. So it's a very low risk entry for the short term. Now he's already identified what stock he's been tracking and he wants to buy. Now he's just trying to get the most advantageous entry point.
That's 1,000% right. And now, Danny, I don't know if I can go back. My computer now has absolutely positively froze. But Donna, we might have to end on this point if I can't get the charts to move. Oh, thank God, to move anymore. No, we're fine. Thank God. So what markets have done here is completely natural. So this is a weekly chart of the S&P 500. As long as this line holds, I'm not really overtly concerned about markets. If the line gives way, I am very concerned about markets. So there's nothing in the history of time that doesn't revert back to the mean. There we go. That's what happened. Thinkorswim was happening. Let me just hit enter on this enough times to get it to go away. Okay, it's not going to go. There it goes. So you can see here is June. This is back in 2019. Market comes up, comes down to the mean, chops around, up, chops around. Then it goes on this beautiful run into 2020. February hits, coronavirus takes hold. But look, when you start closing below the 21, some people will think, okay, we're back in buy the dip mode. No, you got to start closing above the 21 again. You can take a shot, but you got to have a stop out. And so that's February and the March. And by then the VIX futures had inverted. There are a lot of things. That's why we started selling. If you go back and watch our videos, you can see all of this. And then under the 21, it's like Don's, this is a weekly 21. Under the 21, nothing really good happens. And so the market just plummets. And then on daily charts, you want to like start working, you know, like a daily or a 195 or hourly chart to see if you can spot the turn happening in the markets. Look, you're not, even on April, I went back and started looking when I started doing some serious buying at the end of March, beginning of April. You're not late. You don't have to worry about catching this bottom. I'm not concerned about it at all. I don't have to quite sell the top. I don't have to buy the bottom. I just want to know where I'm at in time and space of the market so I can operate. You know, even if on this weekly chart you bought when it closed once and twice over the 21, it pulled back and then it took off, and now you've got this. Now I don't know if this holds. I'll tell you though, if we close under the weekly 21, you're probably going to see more downside. And so the weekly 21 is a big line in the sand for equities. And so it did its job here. That's what you need. Now I don't know if it's going back up here or if we're just going to do this, but I'm sure as hell not going to tell you like, oh yeah, bet the farm. Like there's a whole bet the farm mentality out there with like real estate. Danny, have you seen all the writing going on with real estate that the next big short is the next is like the old big short where you're going to short real estate?
Real estate, yeah.
And the thing about that is if it's obvious to everyone, it's not the trade. And so you just got to let the charts tell you. And I encourage you to go use weekly SPX charts because there's so many in an algorithm charged world. There's so many algorithms that are just written to that. What you got, Don?
Kind of coincidentally, this week, when the market starts correcting, I normally on my charts, MarketSmith gives you 4 moving averages that you can put on. I have the 80 EMA, the 21 EMA, the 50, and the 200. When the market starts correcting, I take off the 8 EMA and replace it with 100 simple, which is basically the equivalent of the 21 on the weekly. And very often you'll find markets get support there, as Tim mentioned, and that is exactly what happened, a bounce on the S&P and the NASDAQ at the 100-day simple or 21E on the weekly this week.
Yeah, up 2% in the Qs on Friday isn't what a bunch of shorts had going in. Oh, let me do this, Don. You just triggered a thought. Hey, Wink, where's your Twitter right here? This is a big deal. You can't make a decision off of this, but it can form your worldview. I'll let Don explain the significance of this, but this is a big number. I mean, this right here is such a large number for, there's the norm. Just people always bearish, right? This is where they're at right now. It's a big honking deal. Go ahead, Don.
This is it's a contrary indicator, but
Yep.
with the low bullishness, that's actually well, let me say this. This sentiment indicator has been not working with some of the other more well-known sentiment indicators, and I want to do some research on them. There's the NAAIM and the Investors Intelligence are 2 other ones that are quoted very often. So you have to, when you're reading about sentiment, you have to be careful of which one you know that you're talking about. Dan, do you ever belong to NAAIM?
No.
It's the National Association of Investment Managers, Active Investment Managers.
Yeah, I know who they are. I followed some of their work and I've read some of their stuff, but
Yeah. So this the NAAIM was at a very high bullish percentage, while this was at a low bullish percentage while the markets were at the top. So you're even getting different results from some sentiment indicators, and that's just so 2020, isn't it? In one of the probably the oddest market we've ever seen.
well, they also call it smart money versus dumb money, or retail money versus institutional money. Although a lot of times the institutional money is wrong too.
And the point of this is that there's so many people bear. I like AAII, and Don last month brought it up, or maybe a month or 2 ago, and I'm like, God, I had forgotten all about that. Bill uses it all the time, and it works. I've seen it work more often than not. That I have confidence in it. I don't know. I spoke at name a couple of times, and I'm not sure about their survey. I don't. It doesn't mean it doesn't.
One of the issues is the way the question for AAII is worded, and the way when you look in the way they describe their audiences, there's a lot of fundamentalists at AAII. So if they're basing their sentiment on their fundamental view of the economy, that may be why the bulls were so low.
Yeah, that absolutely is true. But it had gone up. It had gone up. It wasn't at 46%, Don.
It's more the direction. And here's the point. Here's the reason it's a contrarian indicator. If it's a high bearish indicator, that means more people who aren't just buying whole forever, that actually will make some adjustments. They've already moved to cash. So you already had a lot of sellers get out of the way, and it just takes a few buyers to start moving the market the other way. Everybody's already sold. So
yeah, and like this is what I'm talking about. This has been really difficult down here, and to say that the market, I mean, look at all this low put call ratio, another contrary indicator, but you have this tremendous move higher. This wicked up yesterday higher than it had been just as high as it had been in June. That I started buying more stocks again yesterday, and we'll see how this turns out. I don't, just because I think we're going up to a level, I'm using the NASDAQ here, doesn't mean we're going to, but up 2% on a Friday, the old adage, markets don't bottom on a Friday. There's just no absolutes. And so, I think the next battle is going to be this conglomeration of moving averages at the 21, 34, and 50. And then if you can get there, then we'll see. But I think that I'd be surprised if this didn't carry through till Monday. Nobody believes it today. And then Monday, you get maybe a little bit, it has to follow through. If it doesn't, then this market's got bigger and bigger issues. Anyway, Don, what else you got, man?
A lot of changes this week. I have been talking about hedges that have been put on in the portfolio while I've tried to resist selling as many of the leading stocks that I have, as long as they're holding either the 21 or the 50 moving average, or in the case in some of the bigger NASDAQ techs, as long as they've held a big recent support level. But I use this chart that is based on moving averages and how much exposure I want to the market. And it's a way of forcing myself to not argue with my emotions. And real simple, we closed below the 50-day moving average for the first time during this run last Friday. That was a red flag. And then we had a big gap down Monday morning, but a strong close. And then we rallied up higher on Tuesday. Wednesday came right into the declining 50-day moving average on the NASDAQ 100 and rolled over hard the last 2 days, but came off the low. So I've taken hedges off and put them on and added some stocks to stay within this beta range. And right now, because we're over the 100 and under the 50, I'm looking to be between a 0.5 beta and preferably a 0.75, and that's about where I am right now, is 0.75. If we get back over the 50, then I'll want to have the equivalent of risk of what the market is, which is a beta of 1.0. The S&P 500 has a beta of 1.0.
If people have questions on how you're using beta and moving averages, can they email you?
Sure, absolutely.
There you go. All right, Danny, let's do this. I just looked at the clock. It's 1:25 Central. I think we've been I think we've been going now for 2 hours.
Close. You went on a diatribe.
Well, I thought it was.
Imagine that.
You want to talk sports cards?
No wrestling. All right, folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com, and they can, at the top right there, you can see Tim showing it. You can go to the subscribe button, and we'll send you our daily market insight. It's about a short 10-minute video every night after the market closes. It also directs you to this podcast. Don, would you quit writing on that? Then you can also sign up for the you can sign up for our webinars. That's Don's Lunch and Learn, about once a month, every Wednesday. Don, we got to schedule another one. It's been a little while.
We do, yeah. Yep.
And you know what, Don? Why don't you do your next topic on beta and moving averages? That actually might.
Yeah, I'll include that, and I also want to do. I haven't updated the bear stat since we went through this bear market, so I think I'm going to include that too.
Oh, good one, Don. All right, and if you want to email any of us, you can email us at dan@revereasset.com, Tim at Revere Asset, or Don at Revere Asset, and you can always call us old school at 855 Real Wealth.
You know, I will show people this. Look, there is an archive of videos here, and we don't edit them and we don't take them down, that you can go back. There's 167 pages of videos. That's a lot. But if you go back and you just keep going back, you can go back to March, just keep hitting next to keep hitting next. You can go back to March and actually see, or February, how the plan was developing to sell, how we sold in real time, and how we entered back into the markets. And you go to Don's, you know what I've got, let me show you this. You can go to our YouTube channel, and let me put this in here. And you can actually see Don's bear market. I'll take Wink out of here.
A lot of hairspray on Wink.
Wink Martindale, man, can you imagine going back to the dressing room in the 70s with Wink Martindale? What was that like? Just a whole different time. Is Wink Martindale still with us?
We'll have that answered before the show ends.
Yeah, let's I wonder what he thinks of 2020. So where is it's got like
still alive.
What are you looking for?
I'm looking for the one Don did in January.
Right there, how to stay clear of the bear.
Yeah. There it is. Yeah, the one with 8,700 views. This is the one. This is the class Don taught in January, and then And then before you know it, the market just falls off a cliff in February. And if you go back to all of our videos, and if you want this link, just email or call Danny. He'll get you this link. But if you go, it's a YouTube, but sometimes people have trouble finding the link. But you can see all of our videos. You can see everything we've ever done. And it's the best way. Like some people say, send us a brochure. How are you guys doing? How do you guys operate? I mean, we can tell you anything you want to hear, but that's not the way we operate. The best way to see how we operate is by watching us, doing what you're doing now. And if you want to see how did we perform under real duress, which was back in February and March, that's all up there. We never take anything down. I'll look at one stock here that I'm. This is interesting to me here, this docu chart. And so someone would say, Tim, this does not look, a healthy chart does not look like this. And I like what docu is doing here on, let's take it from some smaller time frames. So here's Thursday, here's Friday. Let's start looking at 195s. So I'm looking for, if this little high can take out, I'm just looking for this to go back up and fill the gap. This thing just got too far ahead of itself. And what I'd like to see, this is not acting the way Zoom is acting. Like Zoom, I wish I still had my Zoom position, because you look on the daily chart, Don, Zoom never lost the 8. Like that, we're going to look at this stock here in a year or two, and it's going to be, it's going to be substantially higher. I mean, there's nobody exiting this stock, whereas docu, they exited. So I don't know if docu goes back to old highs. I'm just looking for docu to see if it could take out the recent high here to go up and start filling these gaps, and then it's got to consolidate and see where it's going to go. We'll see what happens.
You're seeing that exact chart pattern on a lot of the leaders from this bull run, and all it is they're just taking a break, forming a base. They went below their 50-day moving average. They stayed there for a couple of weeks, and now they're coming back up through the 50. And starting the right side, coming up the right side of their bases. That's bullish.
Here's a weekly chart of docu, what the weekly chart looks like, and it's the same kind of entry I did on Spotify, where Spotify is just, this is a weekly chart of spot, where it's just holding that weekly 21 right there. It had this tremendous move. Now it comes off, and now it's going to figure out what it wants to do. If it wants to hold this level, great. If it doesn't, I'm going to have to exit. So Danny, you get the last word.
All right. By the way, I want to say Gale Sayers, rest in peace. Great running back, passed away. And he probably would have been, if he hadn't gotten injured, he might have even been a greater running back than Jim Brown. But he was also a great person. All right, folks. We'll talk to you next week on Your Money.